5 seconds, 10. I don't know. You know how it is, Teams. It takes a while. You never know when. Okay, now it's recording. All right, guys. I'm back with Kevin and ultra special guest, Don Durrett, guys. So if we don't have 100 million views, I'm closing shop. That's it.
Roll up. Come and listen.
Well, Don, I remember Don back in the days when the I think silver just started breaking out, and I was looking at his stock picks, and then I did a podcast covering his top 25 minor picks, and then after that, I remember Don says, Patrick, it's fascinating what you did. He didn't say if it was good or bad. He just said, I think it's fascinating. I'll give you free access to my website, and then when I logged there, I realized about the fundamentals. Oh, look, there's ounces in the ground. What are all these things I have to learn? And then I said, okay, I'll stick to the price action. I let Don and the experts do the fundamentals. But all right, Don, I'll let you introduce yourself because I might destroy your reputation. So
all right. So yeah, Don Durrett. My website's goldstockdata.com. I think it's the best database if you own gold and silver miners. So my database has 850 gold and silver miners. It has some copper miners that have some gold and silver, but basically it's focused, primarily on gold and silver. And I've had it since 2012. So if you have a portfolio at all, you probably want to check it out. Also, I have a book. Wrote a book back. I think first edition came out around 2010, so it's been out over a decade, and I've updated it. The 8th edition is out now. It's really a textbook. So you're going to learn something if you invest in gold and silver mining stocks. So that's the intro for me. Thanks.
Does the book cover technicals and fundamentals?
That's a good question. No, it does not cover technicals, although I do talk about the importance of looking at technicals, looking at charts for entry prices, but I don't go into how to do it. It's already a long book, 300 pages long. It doesn't need anything more, if you will. It's more of a fundamental, how to analyze. It's really about understanding risk. The book is really good at letting you understand risk of the various categories of the miners. So it's a lot of info in that book. Good question, though.
Nice. All right. So Kevin, Don there, I asked him to bring some charts, and he mentioned a few charts that he think that's going to be worth like all of us talk about there, and the implications there going forward. Should I start with maybe the Nasdaq one that Don spotted during our Michael Oliver interview with the momentum, and I could share my screen, and then we could just start hacking away at at that chart, because so here, guys, I have the I can't remember if it was the distance from the 40-week moving average that Michael Oliver had, but I put the 36 not week, month moving average. So this is pretty much like how Michael Oliver he checks. He looks at the structure of a chart, the momentum. So if you can't distance yourself away from the moving average, that means there's some type of problem. And if you do distance yourself away and you have a type of parabolic move after a year, about 12-year ranging bull market nicely going up, that he sees that as a blow off top. And and I was talking with Don right before we started, recently I'm starting to realize that, especially you see in those Dow to silver or Dow to gold ratios, you really want the equities to start stalling. If they keep going up and up and up, that's going to be headwinds for precious metals. But really, we want to see this. We really want to see the U.S. equities start rolling over, and that could be really the catalyst for precious metals.
Yeah, and it's interesting as well. I've just been looking at the S&P chart through this afternoon, and I think I posted that on Twitter just an hour or two ago. I've done that many charts today. I can't remember which ones I posted, but I think that one was one that I put on. And the S&P has just hit the top of a rising channel, and it does look as though, there we go, I did post it. That's a relief. And it's hit the top of that rising channel that we've been in for a good number of years now, and in the process of hitting that top rail, it's formed a bearish rising wedge, which most technical analysts would recognise. A little bit hard to see on that chart, I suppose. You can just pick out the red candle, the latest red candle, just on the tip of that wedge. And when you zoom in on it, which obviously you can't do on that particular chart, you can see that we've broken down from the bearish rising wedge. Oh, there you go, Patrick. You're doing a good job. But when you look at that more closely on the TradingView software, there you can see that yeah, we've got a clear breakdown right at the tip of a bearish rising wedge. So it's, you know, it's this kind of confirmatory evidence that we're looking for to see if there's something developing in the US equities markets.
All right, Don.
Yeah, I wanted to actually go to the S&P next after looking at the Nasdaq. Yeah, the S&P. I mean, I looked at it Sunday, and I tweeted that you know, are we going to see it if the S&P goes lower this week? That could be very significant. And we started off today down 2%, which is really interesting. So let's look at this Nasdaq momentum chart. When Oliver showed this chart, I was like, wow, that is exactly what I've been expecting. Is basically the markets to roll over, and this chart really is showing that. It's showing that it's been in this channel for a long time, this rising channel for a long time, but it never basically broke out to kind of a blow-off level. It never got into danger territory until October. And isn't it interesting that I've been saying that this latest rally from October is the blow-off binge. It's basically, you know, it's been straight up. I mean, we've not had a correction, a 5% correction since October. And so, and it's coming off the heels of this, you know, March 2020 significant correction. So it's kind of like bounced off of that big correction in March, and then we started up. So this binge actually goes back further than October. It actually goes back, you know, to March of 2020. So it's a really, really long run. And I just think, you know, looking at all of, not just the technicals, I know you guys are technical people, but I use both. My first place that I always look is the macro level. And I focus a lot on historical macro, not just what's happening right now, but I always equate it with, I go all the way back to the early 1970s and sometimes all the way back to 1945. And I go from there and I go forward. So I look at the whole picture. So it's like, okay, what is the Nasdaq doing right now? What is the S&P doing right now vis-a-vis the current macro environment and the historical macro environment? I always like to combine. So I look at everything, look at the big picture. That's really what you have to look at. So you can kind of, then you have to get a gut feeling for what's going to happen. And I agree with Oliver. This is a very significant blow off, I think, that is not going to last much longer. The cycle, I think this particular breakout is we're going to see a correction. I say I think it's going to happen in the next 90 days.
Wow.
So now what you have to look at, and what I've been saying is that the U.S. economy is rolling over, and the U.S. economy has basically been rolling over since the late 1990s when it peaked. But it goes back further than that. Remember, I always talk about historical. So if you go back to 1970, 1971, 1972, that was really the peak of the U.S. economy as a mercantilistic economy. That's when we kind of dominated the world. We didn't have a lot of competition. That's where we were making everything. That's where we had, you know, had very little debt. You know, well, you know, 1980 we had $1 trillion in debt. 1970, I think we had like, I don't know the exact number. I'm gonna be wrong, but it was well under 500 billion. Basically, we didn't have very much debt in 1970, 71, and everything started changing. And so we started living off of debt. And that's what happened in the 1980s. So we had the malaise in the 1970s, which was kind of an omen. It was kind of a transition point for the U.S. And we started printing money. And then Reagan got into office in the 80s, and we started globalism. And globalism was where the factories, the U.S. corporations, which had a lot of money, could go and build stuff overseas and make stuff overseas and import it back to the U.S. for a higher profit. And that's what we started seeing the middle class start to get hollowed out. And we start to see real wages basically go flat to negative. And that's been happening for 40 years. And so 40 plus years. So now, if you look at the markets, you have this, again, this hollowing out of the U.S. economy, this rolling over. And so the U.S. has been using debt, and it really kicked into gear. And right after 9/11, after 9/11, that was when, the first time that the U.S. really kind of said debt is no longer the most important thing. I mean, as early as less than a decade earlier, the mid-1990s, the U.S. government thought that debt was the worst thing that you could have, and we balanced the budget in 98, 99 because of our fear of debt. Well, it was, 3 years after we balanced the budget, we've suddenly said debt doesn't matter anymore, and we started printing like crazy. We never looked back. And the reason why we changed our mentality is because Japan printed all that money in the 1990s and did not get inflation. So we thought, oh, heck, we can do it too. We can print money and not get inflation. And we haven't until now. So MMT is really the kind of the Achilles heel of MMT, if you will. So these markets might appear to be going up forever. And the reason why is because we've had low inflation and we've had high liquidity. We've had high injections. As a matter of fact, from 2011, 12 through now, the Fed is actually, it's not part of their so-called agenda. As a matter of fact, they deny it. But every single time the stock market has had any hiccup from, say, 2012 to 20 till now, the Fed has injected money every single time. And if the stock market goes down again, I guarantee you they'll inject again. So that's not a healthy economy. So it's basically mispricing, mispricing risk, mispricing assets. So this is the reason why I'm very bullish gold and silver at this time, because I just don't think the U.S. economy, which is the kryptonite for gold and silver, can just keep going higher and higher based on injections. Is suddenly inflation a good thing? So we haven't had inflation at all until the last, say, 6 months. Now all of a sudden inflation arrives. So look at this chart right here. All we've done is go straight up since 2009. So now all of a sudden inflation arrives and we're just going to keep going higher and inflation is suddenly a good thing. I just don't buy that. That's the reason why I think we're getting ready to roll over. So
but Don, the inflation is transitory there. Do you believe that narrative?
Yeah.
So I mean, if price was to break out of this rising channel and form some kind of pattern like that, it would be a little bit unnatural and it would look pretty much like a bit of a false breakout. So, you've got this bearish rising wedge from a technical point of view, which,
right,
is wanting to break down. And you can see that starting to happen now. The attraction points are back down to the 12-month moving average, somewhere around 3829, I think it is now actually, or the support line that's shown here around the 3,300 to sort of 3,800 area, depending on when price was to get down there. And then below that, of course, you've got the lower support line of the channel itself. So right, move below that and things suddenly get really serious. The wheels do start to fall off a bit below that. But any sort of price movement down as far as the bottom of this channel would, from a technical point of view, be viewed as something pretty normal and pretty healthy, really, involving, I suppose, what would that be, about a 25% haircut.
I think it'll hold. I don't think we'll go below the channel. I've been saying this, that I don't expect a crash, and I think it's going to take a while to go down 20-25% to hit that line. So I'm looking at like an 18-month period, something like that, 12 to 18 months before we get that low. I'm calling for what I call a muddling process. One thing I want to make a point out here is that Michael Oliver's momentum chart fits in really good with your bearish wedge there, your bearish rising wedge. They fit perfectly, right? His momentum chart says, in the Nasdaq, basically says that we're basically going to blow off and we're getting ready to roll over. In the S&P chart, it's showing the same thing here, that this top of this channel is probably going to hold. I mean, look at how many points we have on that channel. I'm counting, more than a dozen. If we go back to 2009, that top channel, it's got like a dozen points. I mean, that thing is solid as a rock, right? So the odds are we're probably going to bounce off it here and go down. And I think it's going to be a 12 to 18 month correction. And we muddle. And I'll tell you what, if we correct for 3 months, I think you're going to have a lot of fear in the markets, because it's going to be a combination of the U.S. injecting money, trying to get that thing going again, and it can't. And you know, everything that Napier said over the weekend, where you have this disconnect, decoupling from inflation and interest rates, which is another fear factor, right? We haven't had that. I mean, he said like the 30s and 40s are the last time we've had anything like that. So we're a generation that's never lived through that before, where you had a disconnect between interest rates and bonds. It hasn't happened in our generation. That's got to create a lot of fear. He also said, which I think is accurate, is that once you get into that scenario where you have low interest rates and relatively high inflation, say over 4%, that people are going to spend their money because they're losing it, basically. Yeah. So inflation kind of forces people to spend money. And so that will create more inflation. His point is this, is that if people spend money, that creates velocity. So velocity creates inflation. So that's actually bad for the stock market, because then you get more inflation. So that's where I say this 18-month period of malaise. And isn't it interesting? Biden, he's basically the Jimmy Carter of new. He's basically the Democrat that's going to live through this era of stagflation malaise, which is what I'm predicting, a period of malaise over sometime over the next 18 months. And then, you know, we'll see where we're at after 18 months. If the economy can start rebounding out of that and start growing. I don't know if we'll have a recession or not through this period of malaise. I would expect one. So basically go into a recession, you know, gold gets bought, goes higher, gets over $2,000. We start this, you know, this run in gold and silver. And, you know, we go into this, you know, this kind of the stagnation malaise era. So that's kind of my play. That's my call.
I think, sorry, Kev.
Yeah, I was just going to say, it's interesting, isn't it? Just overlaying the gold chart on all of this, that gold rises and falls during the period when general equities and the stock market just carry on rising. Throughout this entire period, essentially, the stock market has just risen and risen and risen. And within that period, we've had times when gold has gone up quite sharply, when it's corrected, when it's gone sideways, it's gone up, it's gone down. But the entire time, the stock market just keeps on going.
Yeah, I can explain why from 2009 to 2011, why it went up. So in 2008, when we had that serious recession, the U.S. financial system almost imploded. So you had basically a shock to the system right there in 2008. That created fear. And the fear lasted from till the top of 2012, August 2012, right? That was fear. And fear died. It basically died in 2012, and everybody said, we're fine. And the reason why fear died is because of that channel of the S&P going straight up.
Yeah. Yeah. And the Fed, I suppose the Fed coming to the rescue with crazy amounts of money didn't do any harm either.
Right. And if you look at silver in 2020 was under $18 in March when we got our last basically shock of fear, and silver went up in July and August. It went up $10 in 1 month, and it went up at $10 in 1 month because of fear, and then the fear basically died. There it is, right there. You know, it basically, you know, the fear died in August, and it's been dead ever since. So you had that, and the reason why is because everybody believed in the Fed, and what happened? What happened after March of 2020? We had this huge injection of liquidity, huge, right? What did they spend? Injected like $4 trillion. The Fed's balance sheet doubled, right? And it's still going up $100 billion a month. And so you had this huge injection of liquidity, and everybody said, whoa, we don't need gold and silver. We're fine. Right? And so the fear died in August, and it's been dead ever since. And I've been saying the fear will come back, and once the fear comes back, gold and silver will make the runs. And when they make runs, boy, they make them fast, right?
Yeah.
In 6 months, you go up, big 25% more. Silver 100%, gold 25%.
Yeah, I think it's true to say that in silver bull markets, a huge percentage of the move occurs in a very small percentage of the time. There's a big build up, and then you get all the action is over very, very quickly. So it's volatile to say the least.
Right. That's why nobody's in it and nobody really likes it. So somebody tweeted today that he thought that the amount of people that are really interested in gold and silver is only 200,000 people, which is 0.06 of the population.
Wow.
And he's not that far off. It's under 1 million people that are really, what we're talking about right now, this is a niche. What we're talking about right now, very few people care about.
Yeah.
But it's the ramifications over the next year, 2, 3 for investing is huge in this area. If you look at like Kinross, Kirkland Lake, Barrick, Yamana, the market will be muddling, and those stocks are going to be going up 10% a month.
Jesus.
Yeah. Well, it's a little bit like the analogy being the Titanic. So many people on board, and nobody's interested in the lifeboats. But the lifeboats were in high demand when the thing started to go down, of course. So it's
that's a good analogy. That's a good one. The lifeboats. You want the lifeboats. These are the lifeboats.
Yeah. Well,
yeah.
Don, do you look at like ratios, like the Dow to silver, Dow to gold, to get like? Do you ever look at those?
Yeah, but I use it more for exit. It's way too early in the game. So those numbers now today, all they show you today is opportunity.
Yeah.
Because if you look at them historically, if you go back to 1980, the Dow to gold was 1 to 1, 1 to 1, right? So that's where we're going back to. So I think we're probably going to get to something like, once you get to 3 to 1, 2 to 1, that's when it starts getting frothy. We're not even close to that. So just divide, 34,000 by 1,800 and see what you get. Got your little calculator out?
And help me out here a second, Patrick. What am I typing in wrong? I've got
Dow. You have to type DJI instead of Dow. Type DJI. So remove all that. DJI and use the TVC one. So you have to scroll up there on the.
Okay.
There you go. The TVC / XAU.
I just did it. It's currently 19, by the way, guys.
The ratio is 19. And do you think
we're not even anywhere close to where it's going? Like I said, we don't even get excited until it gets to 3 to 1.
Yeah.
That's how far gold has to run. That's a beautiful chart to look at. That's how far we have to go. Just take it all the way back. Yeah, this is good. Go all the way back to 1980 and show how unbelievable, how far this thing has to go.
That's just that you didn't do it correctly. Yeah.
There you go.
Yeah, this is just the Dow. This is just the Dow on here.
Look at that. So it's unbelievable how far it has to go. So I think basically, people say, well, with inflation, we're never going to see the Dow basically crash. But I'm expecting to see 2 to 1. I really am. So
you want to put the screen up, Patrick, with the ratio on? You might have that.
I'll do it. I'll share.
Favorite. Yeah, good idea.
And Don, because in real terms, the Dow will crash. People don't understand that, because even if nominally the Dow stays at 30, 40,000 over the next 10 years, if gold goes up, that means the Dow is actually crashing.
Right. Yeah, exactly. So even if you get to 4 to 1, it might be, like you said, if you look at it, that's nominally, but if you look at it adjusted for inflation, it might be down to 2 to 1. But my point is that currently we have an unbelievable opportunity here. And that's just one chart that shows this huge upside potential. The other one is, if you look at like the HUI historically or the XAU historically, they're like all-time lows. I mean, it's unbelievable. The upside potential of these miners. Most people won't even. I value gold miners at $2,500 gold, and a lot of people say that's too high, but I think it's very conservative. If you look at some of these gold miners at $3,000 gold, I mean, the upside potential is unbelievable. And silver's, you can double that, right? Keep talking. I'm going to be right back.
Well, this is the one he was referring to. This is the inverse. So this is the gold divided by the Dow.
Yeah.
And each of these points is when the gold was so undervalued versus the Dow. And look at that. We're right here. We've never been so undervalued versus the Dow. And this is our target right here.
Bingo. I've told you, it's unbelievable how cheap the miners are versus the Dow. The upside's huge. Huge.
So if you're talking about risk reward and trying to sort of get into a position yourself in a market that is set to outperform over the next few years, shall we say 3 to 5 years, perhaps as much as 7 to 10 years, then this is somewhere to be looking.
I don't think they're going to allow silver to say get over $150, but I think gold will. Who knows how high gold goes? My upper end target is $3,500, which I think is very conservative. I think we could go a lot higher than $3,500 gold, but you can imagine what the miners would do if we just got to 3,000, right? Just 3,000 they'll go nuts, just nuts. So anything above that is still in play. It's still a possibility. It all depends on how long this bear market goes. But silver is very explosive, but I just think that once we get to like 100, 150, I think shortages are going to be so severe that they're just going to have to do something. They just, there's just not enough silver above ground. So that's
it kind of feels at the moment, Don, doesn't it, that the handle building out on this cup at the moment it's not really wanting to sort of make a clear break at the moment. So it kind of starting to feel to me as though the handle on this cup and handle pattern is going to take a little bit more time to build out. I don't know how much you look at cycle theory, but there's an 8-year cycle ahead, isn't there? Cycle low, I should say.
I agree. I don't think that I'm not expecting a breakout in gold in the next 90 days at all. I've been saying since like February that the first thing that we're going to see is a stock market correction, which pulls gold down. Mm. So, and I'm saying the HUI, which almost got to 250 today, it closed at 257. So my target for the HUI was 220 to 250. So we're already at the upper range of my correction off of 320. We were up at 320 HUI. I said we're still coming. We're going to go back to 250, and we did. And so my lower end is 220, and the reason why it's 220 is because the miners are so cheap. I just don't think they can sell off much below 220. But it wouldn't surprise me if they got all the way down to 200, but it won't last. But my point is that it's going to take a bit of time for gold to go down all the way somewhere. My target is between 1550 and 1650. So it's got to go down quite a bit. You're looking at like $150, $250 drop, right? From here. That's a pretty big drop. So if it goes that far down, it's going to take, probably 3-4 months before it breaks out. So there's your handle. There's your timeline for that handle to get reset.
Here, right here, a few months.
These are December. I think we're looking at December, January is really when gold breaks out here to 2000. I think we got a delay here. So we got this period of time where we can buy miners cheap, and then we break. I think we're going to break out December, January is my target.
Well, it looks like this, right, Kevin? And anybody, like, this is the momentum from the 3-year moving average. Man, we have to do a quattro and add Michael Oliver discussing with us. It'd be epic. And this, look, this is actually this is actually a buying opportunity. As soon as we start testing that upper rail, it's time to load up actually here.
We're really close. We're really close. Yeah.
A few months.
We're like I said, the HUI is at 257. We're getting close to the bottom here. Like I said, my target's 220. We might not even get there. We might only get to 230. And yeah, we're getting really close. It all depends on when the market goes down, do people buy gold? That's going to be the key. And there's a lot of people that think that it's going to get a bid right off the bat. I'm not in that camp, but there's a lot of people that think that gold is going to get a bid almost immediately if the markets drop. But I think that's a real long shot. And so if that happened, then, you know, the HY wouldn't go much below 250.
So you're sort of,
go ahead.
Sorry, I was just going to say you're happy with the sort of expectation that gold could go down $250, but the miners not really got a huge amount of downside, even if that were to happen.
No, I'm not happy. That's just
what what I mean is your sort of your prediction is that even if gold does go down $250, the miners probably wouldn't go down too much.
Yeah, exactly.
Yeah.
That's a better way to say it. No, yeah. I'm not happy with gold going down $200, 250.
I think that's maybe lost in the translation with English.
Yeah,
when we say, "Are you happy with?" It just means, are you sort of content that that's your prediction?
Yeah, I don't want it to happen. I just think it's inevitable based on historical norms.
Yeah.
Historical norms is that when stock market's correct, gold gets pounded. And so that's the likelihood. But I think, yes, exactly what you just said. I think even if gold goes down $200, the HUI is going to hang tough.
Yeah.
They're basically, people are going to say, I'm not selling my miners any lower than this, as low as I go, because they're going to be anticipating a rebound.
Well, that kind of relative strength would be a very bullish indicator for what would.
Yeah, I need to say something. If gold does go under 1,600, then there's a really good chance the HUI goes under 220. Right? My expectation is that gold probably won't go under 1,600 and 220 will hold. So there's always these outliers, right? We don't know how far the markets are going to sell off. Like, I don't think they're going to sell off more than 10% here in the next 90 days. And I think it's probably going to take a while to go down 10%. It's going to be a muddling thing. Like we're seeing today, down 2%, down 1%. I don't think we're going to see down 5% days. I don't even think we're going to see down 4%. We might see one down 4%, but a lot of down 1% days. And they just add up. They add up to down 10% over 90 days. So a 10% drop in the markets will force gold down, 15, 20% maybe. So that's what we're looking at here. And
look, this is like for the Russell, and before we launched in 2010, the Russell was at, this is again the 17-month, the distance from the 17-month moving average. Last time we were this high, it was back out of the 2009 when the Russell exploded. And as soon as it corrected and it started scaring everybody, that first correction out of that 2009 low, and it got back close to its 17-month moving average, that's exactly the moment that silver took off and went ballistic over 8 months. And here's right now, the Russell's right here. So if it could correct, like you're saying, Don, till September, like this is like a arrow, pretty much the angle of if it keeps on this trajectory. If it goes down another 15% all the way into September, man, this is the spot where silver is gonna it's gonna have to start pricing in all the Fed loose monetary policies to save the markets. It should explode like around maybe during Q4 maybe, but it all depends how slowly this thing goes down.
Yeah, I think we're going to go down there and touch a red line right now over the next 90 days. I do.
Yeah, exactly. So July, August, September. Yeah, 3 months. It'll bring us to a 10-15% correction there.
Yeah, I I think that's exactly what we're going to see.
Oh man. And what about like the crash, like a 80%? We've seen this, like some people are calling for 80% market crash, like a 2008 market crash.
Yeah, no crash. We're not going to see a crash. The reason why we're not going to see a crash is because of MMT. I mean, it's pretty obvious, right? Starting in basically 2001, after 9/11, we have exponentially become more comfortable adding debt to our balance sheets, adding debt to the Fed's balance sheets, adding debt to the U.S. government's balance sheets. We have gotten to the point now where we spend money. Look at what we've done during COVID, right? All of the stimulus money that's went out the door. That's not going to stop. So you have this huge injection of money coming. So that's going to prevent a crash. And so it's just too much money. And earlier I said that every time the stock market drops, the Fed injects liquidity. Same thing will happen here. So you're not going to see this 30% crash in the markets.
Wow.
Not going to happen. Now, it could happen over a period of 18 months, slowly and steadily, but we're not going to have a March event where you basically crash 20% in a week. We're not going to get one. That's not going to happen. I don't think.
Here's a number for you, Don. So it took 7 years roughly to increase US national debt from 14 trillion to 21 trillion. The US national debt has just gone up the same 7 trillion in approximately 1 year. So instead of taking 7 years to add that amount to the debt, it's taken 1 year. The debt is now north of 30 trillion, of course. And I just wondered what your sort of thoughts and views were on how that huge debt burden, that's of course not taking into account unfunded liabilities, how that is going to limit the Fed's ability to move when it comes to interest rates and therefore controlling inflation.
Right. Yeah. This is the big story, I think. It's all about the debt bubble and the US dollar and interest rates, and they're all tied together. And I said that MMT is basically exponentially increasing debt because MMT is basically a philosophy, an economic philosophy that liquidity is more important than debt. So that your number one issue, your number one problem is to prevent a liquidity problem, not to prevent a debt problem. So debt is the back seat. Debt is back here. We focus on liquidity, and that's the new mentality, right? And so that is dangerous. They're playing with fire, basically, and we don't know. This is also an experiment. It's an experiment that basically says that we can basically manipulate the economy any way we want to. We can manipulate growth any way we want to. We can manipulate interest rates any way we want to. I mean, look at the 10-year. The 10-year went down to 1.18 today. Can you bring up the 10-year? The daily 10-year chart. So the 10-year went down to 1.1%, and inflation is at 4%. It's insanity, right? The 10-year should be at least 2.5 with the current interest inflation. At least 2.5, even if it's transitory, right? Well, even transitory is going to be 2.5 all day long.
Well, this is the point I'm making a while back, is that this, from a technical point of view, this 10-year yield is in a bullish descending wedge pattern. It wants to break to the upside. The natural forces of this pattern are wanting to pull the 10-year yield upwards, and you can see it did that back in 2018. Got up to around about 3 or just above 3%, but it was knocked down. It was pushed back down again, and that presumably because the debt burden at that level couldn't sustain rates any higher. So the rates were pushed down, and so the debt became sort of manageable again. But the same thing's happened. We've built out a bullish expanding wedge. The 10-year yield has broken out, and it's wanting to break out of this huge pattern that goes back decades. But we're at that point now where I would imagine if we got anywhere near that 3% level with a debt burden of over 30 trillion, then it's a different story. So my thoughts are that the pain that was caused at this 3% level a couple of years ago, 2, 3 years ago, well, that same pain is now going to be caused at a lower level, probably somewhere around 2 to 2.5%, if that even. So it just makes me wonder. I keep returning to this question with guests that we've had, just trying to see what different answers we can get, and because I'm just trying to figure what the answer is here. In order to control any potential rising inflation, the yields have to and interest rates have to rise. But how can that be when the debt is so high and there's such limited scope to do that?
So this chart's beautiful. It shows you very clearly, and it's so obvious to me that I've been talking about the U.S. is basically at a transition point, and this transition point has basically been kind of started in the early 1970s. And this chart shows you that we're trapped, and this is kind of the end game. So if the interest rate on the 10-year cannot go anywhere, it's totally trapped. It doesn't matter which way it goes, it causes pain. If it goes down, and it's at 1.1%, you got 1.9 there. Today it went to 1.1. It went down.
It's not updated yet, I don't think, on this chart, but yeah.
It went down. Are you ready for this? It went down 9% today. 9%. That's like a bluff, right? So 1.1% on the 10-year is basically creates pain because it misprices assets. And mispricing assets just totally screws up the economy. At 1% rate, people, it's basically free money, of course. But the other thing is that people are losing money. That's where the pain comes in. If you buy a bond at 1.1%, you're losing a lot of money. I mean, inflation's at over 4% right now. You're losing 3% on your money. That's pain. Now the other direction, if interest rates go higher, right, it puts headwinds into the economy. It put headwinds into like the housing market. And so we're in a lose-lose situation, not a win-win. The 10-year, like I said, it's trapped. It doesn't matter which way it goes, it loses. And that's what happens when you have a debt bubble and when you have inflation. This chart right here really exposes the unbelievable negative situation for the U.S. economy.
So heads you lose and tails you lose.
You can't win. There's nothing you can. The 10-year, it just shows you there's nothing you can do, and you just go play it out. Now, Napier said we can basically ride the low rates for 3 years, so they can basically this pain. Basically, people can take on pain, so they can't raise rates like you said, because they raise rates and basically the economy dumps. So they're going to try to keep them low. I mean, the 1.1%, I have no doubt. It looks like it went up to 1.2. So it was at 1.18 today. Now it's at 1.19. Napier basically says that if they keep rates low and they inject money, they can basically kick the can down the road maybe 3 years by people accepting the pain. But I think there's too many balls in the air. I just think that this is one chart, right? This is just a 10-year. There's lots of balls they're manipulating. What about the stock market, right? So if the stock market just goes down a little bit, they're going to inject a bunch of money, $1 trillion. If COVID doesn't allow the economy to basically get back on its feet again, that's another ball that they're juggling. So the U.S. dollar is another one they're juggling. The dollar, in my opinion, is overvalued right now. It's at 92.8. We'll have to look at that chart next. Why don't we go ahead and go to that? Let's go ahead and go to the
US dollar, Kev.
Yep.
Your favorite chart, Kevin.
I'm on it. I'm on it.
Go to the DXY. So this is another chart that they're juggling. It's very dangerous. Remember, I just said that that chart, the 10-year, basically shows them trapped, and it's a lose-lose situation. Well, the dollar is also in a lose-lose situation. If it goes down below 88, so it's in a danger zone, right? If it goes under 91 and then it starts leaning towards 90, so it goes like 90.5, gets anywhere close to 90, it gets in a danger zone. I like to talk about these danger zones. So like a good analogy is silver, right? So the danger zone for silver is like 27.50, right? Because once you get to $28 silver, it's hard to stop it, right? So it's like this orange, it's like danger zone, right? You even actually have orange on it. Because once you get down to 88, now let's look at this chart going back a ways. You get under 88 and there's nothing underneath it. There you go. No. There's nothing under 88. And I believe that the dollar is going to close for the year under 88. And why? Because I believe the stock market's going to weaken and foreign money is going to leave the stock market. And when they leave the stock market, they're going to sell their dollars. They're also going to sell their bonds. They're going to say, if the stock market is weak, the bonds are weak, and we're going to sell stocks and bonds. And the dollar is going to go under 88, and it's basically lights out. The game's over. See you later. I can't tell you how important that 88 is. We go under 88, and the next stop is, I hate to say it, 70. After 88, it's 70. In other words, we're going to hit 70 before we hit 89. I don't know how long it'll take. I don't know how long it'll take to get to 70. There you go. There it is, right there. That's where we're going next. Down to, you got it at 74. So I'm close. 72. No, I'll go all the way over. It looks like 7. Oh, you're redoing it.
Yeah, I'm just readjusting the arc for you. But
there you go. It's the 71, 72. Yeah. That's where we're going next. Once we
have a whole bunch of targets. Yeah, I have a. Sorry, I just did so many charts on the DXY. I have a whole range of targets. But you're right. If we close above those levels you mentioned, especially on a yearly close, man,
Okay, I got you. We'll go back to this, but I want to finish my point about how it's trapped. So if the dollar goes higher, let's say the dollar goes to 94.95, that completely screws the rest of the world. Completely. The rest of the world right now is dealing with inflation, right? All these third world countries that have all these dollar reserves and buys their goods in dollars. So we're exporting inflation. So whenever the dollar is strong, those foreign currencies are weak, and it creates inflation in these countries. So 95, if the dollar goes to 95, it obliterates the global economy, and it hurts the US corporations. So that's why it's at 92. It's unbelievable. If you look at these things, everything is kind of like right where it has to be. 2% on the 10-year. I mean, 1.5% on the 10 years. Like it's oversold right now. I think it's oversold because somebody's paranoid. Somebody wants it low because they're afraid it's going to go higher. So, and that happens. That's why silver's at 25. It's like when they're nervous, they want to get away from these danger zones. They get pushed, basically oversold. Silver's oversold at 25. The 10 years oversold at 1.1, 1.2. The dollar's it's basically right where they wanted at 92. I always talk about how the banksters, they have these numbers. They're like their comfort zones. Remember I talked about the danger zone? I also talk about comfort zones. They always like to be in their comfort zone so they can basically clink their scotch glasses, on Saturday night. Everything's good. So they like to be in their comfort zone. 92 is a comfort zone for the dollar. But I'll tell you, it's remember I said, we looked at that 10-year chart. We saw how tight it's getting, right? It's getting really, really tight. The danger zones are getting really, really big. Same with the dollar. The danger zones on the dollar are getting really big. I mean, 94, 95, 90 to 88. It's getting really tight for the dollar. And some people are really bullish the dollar and think it's going to go to 95. I'm telling you, 95 is serious pain for the global economy.
Yeah.
It's getting pretty squished in that red zone I've marked on that chart there. So it's
you guys realize that the reason why I could be completely wrong here, but I think that the reason why we had riots in Cuba and South Africa because it was inflation. Inflation. I really believe that. Because those countries, they basically live paycheck to paycheck and can barely afford their monthly food, right? It's really, really tight. And we have high inflation right now. And that's like the little trigger. It's like the trigger, right? I just and if you go to 95, on the dollar, you're going to get food inflation everywhere.
Yeah, it's
people aren't going to be happy about that.
No,
Yeah,
no, they're not. And we haven't really even talked about my main theme of the global economy basically shifting to Asia. But
Yes.
maybe that'll come up. Maybe it won't. We'll just keep going on charts.
well,
No,
Don, man, it's I love hearing you talk because my dad's Lebanese, and I hear all the stories of Lebanon and they're in inflation, like the Lebanese is pegged to the U.S. dollar, but on the black market it lost like 80 or 90% of its value in, like, I don't know, a year. And it's the food that makes them riot. They went to the central bank and they threw stuff at it, or they try to break the door. I told my girlfriend, when my girlfriend comes home and says, "Babe, I need more money to pay the groceries in Canada," I'm gonna freak out, because that's when it gets people. Hey,
Yeah.
how come I can't get food for my kids? That's when people, they go
Right.
like, they realize something's up.
Yep. Oh no, I wanted you bring the DXY back. Patrick, you didn't get a chance to talk about it.
Well,
This is your favorite chart, so go ahead.
Well, the DXY, the way I see it, it's a since they unpegged with the Bretton Woods there in 71, I see it as a controlled demolition job. They know exactly what they're doing with it, and it comes in lines with what you said, that they know to keep it. Look, I don't want to go down conspiracy theories, but the way I see it behave is they manipulate it downwards just to for their means. But we're approaching Jesus. We're at the bottom. How lower can it go, this thing, And they can't go up, so it's trapped. And look, if you adjust it for inflation, the U.S. dollar is programmed to lose value since 1968. It's just been going. It's never made a new high, inflation adjusted, since it's been unpegged. And it just looks like a perfect controlled demolition job.
That fits my philosophy of basically they put it where they want it.
Yeah. But what do they do when it's at zero? Like they'll have to stop that when they come out with their whatever, like their pitchforks, right? That's when it stops.
Well, I think that we've talked about a lot of negativity about the U.S. economy. I'm gonna, before we go to the euro, I want to kind of squeeze in here Southeast Asia. It's my belief that China and Japan and Korea, those were like kind of the three biggies, and then you can throw India in there as well, even Australia and Indonesia. Those countries have all been on the rise, especially China, as we all know, since the 1990s and the 2000s is kind of China became awake. Well, Southeast Asia and Asia in particular now is the largest economy in the world. Nobody really even knows this. Everybody thinks the US is number one and Europe is number two. It's not. Asia is number one. It's the biggest market. And it's been a recent phenomenon that Asia has become the number one market in the world. This is what blows my mind, is that Asia is the number one economy in the world, and China is not part of the G7. And last time that the G7 met, all they did was talk about China. This is a transition point. And the dollar is right there. We're talking about the dollar, we're talking about the euro, but it is my firm belief that we are transitioning away from a global, basically global economic dominance of the US. And that basically Asia is going to start kind of making the rules here and going to really start. I don't know when they're going to kind of pull the rug out from under the U.S., but at a certain point, I expect them to, because it's more in their interest to harm the U.S., even though it's a big, economy for them. It's more in their interest to basically make the rules than it is for them to play by the rules and to, for their growth. I think they want to be more in a position of strength, even if that requires them to hurt one of their markets, if you will. And so I think we're in a global transition. It's happening right now before our eyes. It's going to happen in this decade. And by the end of this decade, I think this all basically, my whole point here is this all reverberates back to the dollar. That's why the dollar is going to 70, 71, 72, because Southeast Asia is basically going to rotate away from the dollar. I don't know how, but I expect them to rotate away from the dollar, and I expect them to rotate away from US bonds. So you got the biggest holders of bonds is China and Japan. And I think they're going to sell their bonds. The dollar's going to get hurt. I don't know what's going to happen. The dollar's going to go down. It's going to be nasty. But I don't see the US economy crashing, but I see it basically weakening substantially. Okay, that's my...
Well, check. That's that chart, the way Kevin drew it, we're looking at a 65, 68 in 2024 maybe there for the US dollar.
Holy moly. I was too conservative. My 70 was way too conservative.
Yeah, well, the thing, like, there's always extremes. What I've noticed is on the heart, like, it's the wicks of those candles. Like when there's a spike, like maybe on the intraday, it could like go down, but then after that, it comes back to more reasonable levels. This
chart's beautiful. This chart is not hyperbole. This chart basically shows you what's very, very possible. And this shows you my theory. It's interesting that you brought this chart up right after I talked about how Southeast Asia is, the largest economy right now and how they're going to basically force their will on the U.S. This chart shows that the U.S. dollar is probably going to get revalued in some way, downward.
Of course. Well, it hasn't shown previously that it was revalued higher for long periods of time, right? It's always been revalued downwards since like the past 40, 50 years.
Yeah, look at 2008. Isn't it interesting? Look at 2008. We touched that line in 2008, the last recession. Why can't we touch it again during this recession?
It's I think when the US dollar overheats, it shows the cracks in everything. So every time the US dollar spikes, the VIX spikes, the gold to silver ratio spike, and then the markets, they really don't like it. They either stall or they start having red days. And once the US dollar goes down, then everybody's happy, US equities go up, and the volatility goes down.
Sorry, guys, I was getting carried away with drawing the chart.
I know.
I'm sitting here listening to what you're saying and just drawing the chart as you're talking. So I am listening.
Well, you know what, Kev? This could be a great concept. Is the charts inspired by the speaker? I love it.
I can't help myself, but yeah, we might have hit on something here.
And well, there's the 80 line also, Don. That's very critical. So there's if Kevin could put the 6 months chart. Could you indulge me, Kevin, and just put on the 6 month to reduce even more noise? This one I often and then put a horizontal line like around that 80 or I think it's 92 level. Yeah, 92.
I actually have not seen these charts. I had no idea that that bottom line was basically pointing at below 70. I did not know that. Jeez.
Look at that.
It's pretty stunning to me. And the support line is below 70. That's crazy.
This is where sort of fundamentals and technical analysis, they sort of kind of come together, and it's really, really good to listen to different people's perspective and points of view, because it's all evidence gathering.
I just gave you an argument for how it can happen.
Yeah.
We could do this all day, man.
You remember I told you that if the dollar goes to 95, that we're going to be exporting inflation. It's going to hurt the rest of the world, right? So why would people want to be pegged to the dollar when it's hurting them?
Yeah,
exactly, right? So if inflation looks like it's going to be somewhat strong, at least for another 12 months, and who knows how much longer than that. So if the dollar goes up and inflation remains high, people are going to go, get rid of this dollar. It's killing me.
I was looking at a map on Twitter today, Don, and it was a map of who, all the countries around the world and who their biggest trading partner is. And I think it was something like 30, 40 years ago. about 80% of the world did the majority of their trade with the United States. And then it's got the same map for today, and it's 80-90% of the world does its trade with China.
Exactly.
So it's or at least that China is its main trading partner. So
Great
it's a
point, Kevin.
fascinating.
Great point. And people need to connect the dots. So
Yeah.
they're trading with China, yet the US dollar is basically killing them, or not killing them, but it's hurting them through inflation because the US is printing so much money. And at a certain point, and I think it's happening now, countries basically start to push back. And one of the ways they push back is they don't use the dollar in their trading. So we saw Indonesia last month basically make an announcement that they're going to try to start de-emphasizing the dollar in their trading. And that's and the reason why is because of all this printing. You mentioned that the dollar was basically, the amount of dollars in circulation was doubled in 12 months. Am I right on that?
The M2
basically gone from 21 to 30 trillion. So it's gone up 7 trillion in about 12 months, I think it is, roughly speaking.
So almost 50%, something like that.
Yeah, it's incredible. The rate of dollar creation is basically exponential, isn't it?
Yeah, with the MMT. And so the global, and you made just a great point about how the rest of the world is really trading more with China than they are with us. So why are they on this dollar standard? It doesn't really make sense to them. And so if that breaks down, this chart is relevant. This chart basically comes into play. It's not, I used the word hyperbole before. It's basically, it's something to take seriously. That is an outcome that could happen. It's not, it's not crazy talk.
It's not crazy talk. It's not like saying if DXY is going to 170 or DXY is going to 30. This is technical analysis. It's trends. It's like and lines. There's a guy I follow on Twitter, Shism, and he says lines, they beg to get tested. Important lines, they're like magnets. They want to. They attract.
Yes. Sorry to interrupt, Patrick, but that's what I use. That's a term I use all the time. Is that these support and resistance lines are like magnets. It's a beautiful term. Sorry to interrupt, but that's what I want to just make one more point and let you speak. Is that people don't realize, but when silver gets over 30, there's only two magnets left, 35 and an all-time high. So what's going to happen once it gets over 30? I mean, you could say 3150, the kind of the danger zone. They might be able to fight it off. But once it gets over 30, because the last two times that silver went from 30 to 50, it did it really, really quickly. So there's no resistance. So the magnet is 35, and it's going to go zip. It's going to go right there. Just like this one's going to be a magnet. Once it gets under 88, it's going to be a magnet to like 80, and once silver hits 35, it's going to be a magnet to 50. So yeah, magnets. That's a really good analogy.
I mean, these lines, they're like sort of magnets or force fields, and how someone can look at that and dismiss it and say that the lines aren't relevant and they don't mean anything. I mean, you just have to count up the number of times that these lines are tested. Once, twice, three times, four times, 5, 6, 7, 8, 9. Same here. Tested, pass the test every single time. So these lines are telling us something important. They're guiding the price.
The one that's beautiful is the DXY. What does it hit? Over 20 times?
Yeah, over and over and over again. So
unbelievable. That one blows my mind.
Kev, one last thing for me. I just noticed, Kev, I don't know if you could zoom in on that third arc.
Yeah.
So and especially in the height, and you see, you drew that line at the support on these are 6-month candle closes. Can you draw a parallel line, but on those 2016 lows? Closes.
Lows.
Closes.
Down here?
No, 2016. So a little.
16.
Wow, look at that.
I just want to show to the point of the Don that and click and drag and make a parallel line just above it, all the way to those lows.
There.
Right there. And
now
I just want to show.
Now I see why this is your favorite chart.
And just to show that on the smaller time frames, we could be going up, but as long as we close the year back below 92, it's still in a bearish configuration. So right now it's just like a bear flagging on the potentially going down. So we're running into a wall, which a wall is something, its previous support or resistance turned the opposite. So right now we might seep through on the smaller time frames through this wall at 92, but if this is to hold the scenario, then by the end of the year, these are 6-month candles. We're going to close below 92.
And if you remember, there was a lot of jubilation
I
amongst the dollar bulls here back in 2020 when the dollar broke above this arc chart, which I'd been touting on Twitter and various other places. And as the price broke out of this arc, it just as quickly reversed and got back inside it. So this sort of pattern which has contained the dollar all this time, even though we temporarily broke out on a smaller time frame, then sure enough it was rejected and pushed back inside again. Same thing happened here, although it didn't manage to break out. So it looks as though this arc is really strong in terms of the downward pressure it's exerting on the dollar.
Yeah, the other thing, this is gonna be pure coincidence, right? But I've been saying heck since, I don't know, before January, at least January, that we're going to close the year below 88. So looking at your chart right there, what I expect to see is a red candle, but you're going to see it's going to trade above the arc, but it'll close below. It's going to close below it. I think that's exactly what we're going to see with the next one. We're basically we're going to end up closing below 88, and everything, it's going to be basically a reversal candle. So the next candle at the first of the year is going to be a reversal candle, and it's going to be the most important. This is if I'm right, it's going to be the most important candle in the history of the United States for the dollar.
Oh man,
I'm trying to
just got shivers.
Yeah.
It is. You're right, Don, because the 6-month close in December 31st, the yearly candle, if Kevin would put the yearly chart, it'd be the significance is astronomical chart wise, technical wise, and visibly fundamental wise. It's happening now, right? Whatever's getting played out, it's playing out now.
Yeah, and I've been saying this, that COVID was the basically the prick that popped the U.S. bubble that. There's no going back. It's basically, historically, we're going to look back that was the end of the U.S. empire, was COVID. And so this candle is basically going to show through the chart that is where the dollar died. Once the dollar goes under 88, I don't see it ever going above 88 again. That's my prediction.
Yeah. And
especially
inflation adjusted, it's never made a new high. Never made a new high when you're inflation adjusted. Because even if the DXY goes up nominally, they created so much inflation to get it up there that it's worthless.
Right.
Well, it's not worthless.
My takeaway from this whole conversation was what Kevin said about the rest of the world trading with China. That is really the most important factor in everything, because the U.S. has basically exerted its will since 1945 on the economy. It's been able to kind of do whatever it wants economically, about setting, using the dollar any way that it wants to, setting interest rates, printing money at will, having that global, that dollar global currency. It's been, setting the tone, making the rules, doing the whole deal, right? And, what Kevin brought up, that, the U.S. is no longer the #1 trading partner of all these countries. That to me just signifies everything.
Jesus.
Yeah, huge implications for everybody going forwards, isn't it?
Yeah. Well, and then not only is that everything I just said true, but Asia is the only area in the world today that's growing economically. If you look at North America and South America, pretty stagnant. You don't have a lot of growth going on. Brazil, maybe a little bit, but not a lot, right?
Well, basically, we're into the age of diminishing returns. You have a strong growth phase just like you do in many things in nature. You get a very strong growth phase, and then you need ever increasing amounts of energy just to maintain the same amount of growth until eventually, that energy can't be found, growth decays, and you end up in decline, some kind of collapse of some description that then out of the ashes is reborn a new system.
Right. And to follow up my thought, Europe, which is the second largest economy, they're flat, right? They haven't grown that much in 20 years, kind of like Japan hasn't grown much in 20 years. And then who is the number one trading partner with Africa, without a doubt, by far? It's China. Yeah. And Africa is the one place where you have growth. So you got Africa and you got Asia, who are basically both kind of tied at the hip, and that's where you have growth. Vietnam, I mean, look at the currencies around the world. Where do you want to have your money? I mean, I think that Vietnam, Korea, Indonesia, Thailand, I think these are the currencies that are probably going to be strong going forward because they're mercantilistic economies that are growing. That's all Asia. I mean, where do you want to invest your money? You want to invest it in Asia. So, the dollar doesn't really hold up well when you kind of throw some analysis at it. And one thing that's interesting is somebody wrote a book, I won't bring up his name, he basically says that he thinks, we could be totally wrong, so I'm just throwing throwing water on us, basically saying everything that we've been talking about for the last hour is bogus baloney. He basically says that the U.S. economy is going to come back stronger than bigger than ever because of our economic system, which basically creates a lot of basically entrepreneurial type of businesses, business generation, and our financial system, which is bar none the best, and our educational system is bar none the best. So you throw those three factors in, he says the U.S. is getting ready to basically dominate this decade. He might be right. We could be wrong. So I just want to throw that out there, that everything that we're saying right now is basically our opinions. We could be totally wrong.
And that's where the technical analysis comes in, I think, because these discussions that we've been having can be represented on these charts, so we can find the lines in the sand. So with that dollar chart that we've just been looking at, we can see very clearly where the lines in the sand are. So if what we've been talking about, the roadmap starts to break down, we can very quickly identify that. So that's the important thing, I think, for investors and anybody with an interest in the markets going forwards, is to have that roadmap to hand. You don't want to step off the edge of a cliff without knowing that you're about to put your foot over the cliff edge. Why would anybody go climbing in mountains in thick fog without a map and a compass? And that's exactly the same thing with chart trading. You need to have your map and your compass. The fundamentals give you very good ideas and gives you discussions and gives you a backdrop, and the technicals are just like having a map in front of you. And it's all gathering evidence from my point of view, and the way I see it anyway. It's evidence gathering and bringing pieces of this huge jigsaw puzzle together. And the discussion that we've just had with you, Don, there is really enlightening. I hope everybody listening will be finding that as informative and fascinating as we did.
Let's do it again in January.
Yeah.
We can review all of our predictions and see where we're at, especially where everything is at, right? But the dollar, the 10-year, the stock market. Let's do it. Put it on our calendars for January. Maybe the first week of January would be great. So you're probably gonna have to break this into two. I see on my clock we've been doing this for an hour and 22 minutes.
We've got some very dedicated watchers and listeners, so I think they'll grab their coffees or their beers and listen to this, I'm sure.
Yeah, I'm awful at editing, but and I'm pretty sure I'm going to re-listen to this for the entire hour. And it was captivating, Don. I'm super happy to meet you virtually. Maybe this is the closest we could do it for now there, but you're like a legend out there, in the mining community. And it was an honor that you accepted to talk to us.
We were absolutely over the moon that you agreed to do it, Don. Thank you very much.
Thanks. Yeah, I appreciate being on, guys. It was great. Thanks again.
Fantastic. Thanks, everybody. Sorry,
guys.
Sorry.
Well, we're going to put your links in the description, but if you want to mention for the guys that are still listening there, if you want to mention where they could find you, the best ways.
Yeah, we did it in the beginning, but it's just goldstockdata.com, my website, and then my book on Amazon. Just search by my name, Don Durrett. You'll find the gold book. All right, awesome, guys.
Don. It was a pleasure, Don. Take care,
Great.
man.
Thank you, Don. Cheers.
Thanks.
Thank you.